Well, hey everyone, Dave Keller here with Market Misbehavior. Happy Tuesday, November 11th, and welcome to the show. We're coming to you from a beautiful, cool, but nice and dry fall day here in Redmond, Washington. Hope you guys are all doing well. I've talked to a number of people in snowy areas of the country, particularly down south, where some are facing that. So stay safe and enjoy the winter weather. Those of you that celebrate here this week. Decent day, depending on which area of the market you're looking at. Decent day for healthcare, which ended up being the top performing S&P sector today. We're going to look at a couple of those names, 3 or 4 of them that I was jotting down as I was going through the market carpet earlier and identifying some areas of strength. Not as good for some technology areas. You're going to see the Dow actually had a resilient up day while the NASDAQ finished in the red and the S&P kind of in the middle here. So back to kind of a value over growth kind of vibe to this market. I mean, I feel like there's just still a lack of clear sense of direction for this market. I mean, granted, so far this week, we had the gap higher on Monday and a little bit higher today. Certainly there's optimism surrounding, the hopefully very likely government shutdown being ended here through the course of this week. All signs point to that being the case, which I think would be a really good thing. Just the fact that we were able to move past that and get things back up and running in a lot of ways. And the market is taking that as sort of a risk on move, but not all measures of risk are looking particularly good, particularly cryptocurrencies continuing to struggle here, having some pretty steep down days. Not looking a lot like the up days in the Dow Jones Industrial Average. Can't thank you guys enough for tuning in, watching the show. Thanks so much. Please continue watching. Please tell your friends that are looking at the markets and you think would be interested in some a lively discussion of charting patterns and trends. Always would love to have a couple more people watching the show. As a reminder, we do take your questions through the comments section of our YouTube channel. And we'll do an all mailbag episode on Friday. We'd love to answer your questions there for sure. Sorry, I was jumping around a lot, getting prepared for the show. Let's get back to the market dashboard here on stock charts, and we can see that the S&P finishing up 0.2%. S&P closed just below 68.47. So what? 0.2% higher from yesterday. Out of the open, we were down around 68.10. And then got up as high as around just over 68.50, 68.55 before settling into today's close. Here's the thing, though. Look at the Dow. Just a nice, consistent uptrend through the course of the day. Dow almost broke 48,000 today, up 1.2%. And then here's the NASDAQ, which sold off pretty aggressively out of the open. So around lunchtime, it was Dow up big time, NASDAQ down big time, S&P slightly lower. Through the course of the day, NASDAQ improved enough to help the S&P up and finish slightly higher. But basically, this was a big gap between the Dow and the NASDAQ, 2 very different days. And again, nice rally midday for the NASDAQ, but did end up slightly in the red, down about 0.25%. Mid caps were flat for the day. Small caps slightly higher. And the S&P 600 did outperform the S&P today, but not by much. Volatility continuing to lighten up. Had a really fun interview earlier today. It's not ready for you. Hopefully we'll get it to you tomorrow, later this week, with Andrew Thrasher. Andrew's a fellow CMT technical analyst, portfolio manager. Some really good thoughts about volatility. He's actually won a Charles H. Dow Award from the CMT Association for his research on volatility and looking at volatility compression and volatility expansion. Was able to ask him about that and his research, but also applying it to the current market environment. So be prepared for that episode to be dropped very, very soon. Keep an eye on my YouTube channel, my social media platforms or accounts, and I'll make sure I'll make some noise when that's posted. So VIX continuing to come in. We're down at a 17 handle. That means a low volatility environment. That means conditions are pretty good. Bond markets were closed today for Veterans Day. So thank you so much, those of you that have served. Can't tell you how much we appreciate your service. And as a result, while the equity markets now are open for Veterans Day, bond markets are closed. So no real change to bond prices or ETFs that we're going to talk too much about here. Dollar slightly lower through the course of the day today. Looking at the commodity space, generally higher crude oil prices, natural gas prices actually did quite well. The energy sector didn't quite beat out healthcare for the top slot today, but was in the top three. Gold and silver continued to do quite nicely here. Silver actually had a very strong day. Gold, chopping around moving average support now, potentially returning into an uptrend phase here through the course of this week. Cryptocurrencies, boy, a lot of not good here. Bitcoin yesterday did get up to around 107,000. From there, it's rotated lower. Currently, as we're recording this show, it's just above 102,500. That's down over 3% from yesterday. Ether price is down 4.5%. All of the top 10 coins here in the red. So, again, this might be helpful if you actually trade Bitcoin and Ethereum or Bitcoin and Ethereum ETFs or any of these other cryptocurrencies in some sort of wallet or some sort of exchange. But even if you don't, I think there's great value in paying attention to cryptocurrencies because these are basically a great representation of speculative pressure. There's not a lot of fundamental data behind Bitcoin and Ethereum. There's some about mining statistics and accounts and things like that. But generally, this is way more about, I would argue, way more about sentiment, way more about euphoria, optimism, pessimism, fear of missing out, fear of losing everything. And I think we're seeing downside pressure from fear here in recent weeks. And today, really a risk-off move as Bitcoin and Ethereum and the rest of the top 10 coins all in the red. Sector's not bad. And one of the things we'll show today, the volume conditions improving a bit. We talked about how the Chaikin money flow got back to above zero yesterday, continue to be a little bit higher here today. Breadth conditions, which have been the biggest probably red flag for this market since the end of June. Just every new high has been marked by weaker breadth readings. Breadth improving a bit here yesterday and today. You're going to see that some stocks are actually breaking above their 50-day moving average. You're going to see on a day like today, 10 out of the 11 S&P sectors managed to finish in the green. It was down. It was less than that earlier in the day. Every time I checked in, there's more and more sectors. So only one of the S&P sectors finished down on the day. We'll start at the bottom. And the problem is it's the biggest, technology, the XLK. So, biggest risk in this environment, I would say, right? The bear case, given the deterioration we've seen in breadth, given the deterioration we've seen in price momentum, next, the logical step, I would say, having analyzed a bunch of market tops, you start to see some serious leadership rotation. You see the previous leaders, which would be technology, especially semiconductors, starting to struggle. I think there's no denying we've seen, at least some, plentiful signs of that sort of struggle. Not end of the world breakdowns, and a lot of semiconductor stocks are still very, very close to their previous all-time high, which they just hit maybe in the last week. But they're certainly not leading the market today, and they're not leading the market in the last week. And I think that is one big question mark. The other thing would be an improvement in defensive sectors. That takes us to the top of the list. Healthcare, the XLV, up 2.3% today. Chart of the XLV, pretty impressive here. I don't think I grabbed that, but I will try to remember to do so. Energy and consumer staples basically tied for second place today, both up 1.3%. So healthcare, energy, consumer staples. Cannot remember the last time that's been the 1, 2, 3 at the top of the leaderboard. That's an unusual combination of defensive and cyclical sectors with healthcare, energy, and consumer staples. That consumer staples one is an important one because if that keeps outperforming consumer discretionary, which is only up about 0.25%, it's one of the key ratios we look at, which we call offense versus defense, going down today. All right, looking at the breadth conditions, as I mentioned, not too bad. Now, it depends on what index you look at to determine how good it was. But on most of these, particularly the major indexes like the New York NYSE and the S&P 500, about a 2-to-1 ratio on the of advancers versus decliners. On the New York Stock Exchange, 64% of stocks finished higher today versus 34% that finished lower. On the S&P, it's a little better, 69% up to 31% down. So encouraging, right? And certainly encouraging that you're seeing a broader move higher this week. Still plenty of risks out there, still watching the lines in the sand, still looking at things like cryptocurrencies rolling over and not feeling particularly good about what that means about speculative pressures here in November of 2025. But that's where we're at. Magnificent Seven stocks basically split today. On the upside, you have Apple Netflix, both up about 1.5 to 2%, maybe even a little more on the downside, though. And this is the problem. We talked about, the weakness in previous leadership. It's often a great tell that there is a change of character, a structural change in leadership that often coincides with the market top. Here's NVIDIA down 3% today. Here's Broadcom in that same semiconductor group down 1.8%. Tesla down 1.3%. Meta, again, I think wins the clear award out of this list of stocks as being the least technically attractive, having broken through moving average support, just kind of languishing, continuing to make lower lows and lower highs. NVIDIA and Broadcom, though, are concerning because these had obviously been some of the stronger areas of the market, starting to struggle here a bit. All right, that's what happened today in the markets. Let's spend a little more time focusing on some sector and group themes, and then I have hand-selected some charts to review with you. So, I mean, two things jump off the page at me, and I love a day like this. Sometimes you look at the heat map, and for me, I have to take a couple seconds, kind of look around and just think like, what's the real message here? I think the real message here today is crystal clear. And there's one sector that did remarkably well, arguably way better than probably many people expected. And then there's one sector that did a lot worse than probably a lot of people hope. The sector that did better than expected is healthcare, right in the middle of the list. Look at the up days that you see from Johnny John, AbbVie, Merck. All of those are up, 2-4+% today. Biotechs like Amgen, Gilead, and others. Pharmaceuticals like Pfizer, BMY, Bristol Myers starting to break out above resistance, maybe clearing a consolidation phase. I'm going to grab a couple of those charts here in a minute and go through some of them because I meant to grab them and put them on my chart list and I just forgot. So we're going to go back and do that in a minute. But I do want to take a few moments and highlight a sector that definitely struggled today, right? In technology, NVIDIA down, Micron down, LRCX, AMD, Applied Materials. These are a bunch of big semiconductor names that were all down pretty good today. So that weakness in semiconductors, I would argue, is a challenge. I mean, are these horrible charts? Like, no, right? I mean, if you look at the chart of KLAC, you can't call that a bad chart at this point, right? You could say here are some signs that maybe we're near the end of an uptrend. That I would maybe accept as a valid technical argument. I think the most obvious signal would be the divergence, right? The bearish momentum divergence. And KLAC isn't the only one, but it's the one that comes to mind here. Very overbought there at the beginning of October. New high on weaker momentum, not quite getting overbought there a couple weeks ago. So higher prices on lower momentum. That's a bearish momentum divergence. Often indicates that we are at the ending stage of a rally. The last time we had a really clear bearish divergence was in June and July. We ended up selling off for about 6 weeks going into the early September low before we recovered and broke above 950 and got up to the levels we are now, around $1,200 a share. We have a similar bearish momentum divergence. When you have that divergence, I think you look for initial signs of warning. Breaking below the 21-day EMA would be a very basic, simplistic measure that at least some sign of weakness is materializing. If that would happen, like we saw in the beginning of October, my next check would be immediately down to the RSI. Does the RSI hold 40? It did in early October. If it would not, that would be a very dangerous sign here. So generally, the structure here, stronger prices, weaker momentum. This is a problem in a number of semiconductor stocks. But is this still in an uptrend of higher highs and higher lows? It very much is. Is it still very, very close to its all-time high that it just set at the end of last month? It is. So it's not a bad chart yet. It's just showing signs that this euphoric rise may be nearing an ending point. So something to keep in mind there. And that's kind of what I would think about semiconductors. I did grab a chart of the SMH to look at in a moment. In the financial sector, I just wanted to highlight too, with more of a tie to the crypto trading sort of brokerage environment, Robinhood and Coinbase, both having pretty good down days here. Robinhood's not bad. Robinhood's a sideways chart. It's consolidating. I think a chart like Robinhood is a perfect time to bring up one of my favorite Jesse Livermore quotes. There's time to go long, time to go short, time to go fishing. His way of thinking was there's times when the chart tells you, at least this is how I would translate it to the modern age. There are times when the chart tells you this is a strong upside potential, clear uptrend. There's times when the chart says clear distribution, clear downside potential. And then there's times when the chart's telling you to hold on and wait and sit on your hands and just wait for the right signal. I think you're seeing that with Robinhood. We've highlighted that with other charts. I think like GEHC, we just talked about. There's another one, Stanley Black & Decker, maybe SWK. Is that right? No, I forget which other chart there was, kind of the sideways consolidation. But I mean, that's where this is, right? I mean, we have consistent highs, consistent lows, are sort of in this sideways trend. So pretty easy chart to play from a technical perspective. You wait for the break, right? We either break above the upper boundary or we break below the lower boundary. And whichever way we break, I would argue that's the direction of momentum that you probably want to be following. So doing a highlight two of those charts in financials, clear downside outliers today, and Coinbase down another 4+% on weakness in cryptocurrencies. Let's talk about some healthcare charts here, and then we'll look at some other charts that I've hand selected here. Within healthcare, I mean, the whole sector was up today, and I think of it in a couple different areas. Gilead is one of those. It's just a decent chart, right? We've had a couple pullbacks, a number of pullbacks actually to the 50-day moving average since May. Pretty much every one of those has eventually turned higher and eventually made a new swing high. And I think at this point, for me, it's a signal. Alert would be a break above 125 that would clear this previous resistance and certainly indicate to me a nice new uptrend leg. But I like that sort of long-term structural trend. Johnson & Johnson getting back to retest those previous highs. So for me, you have to remember, this is a nice pullback to an ascending 50-day moving average. RSI holding above 40, kind of has all the makings of a buyable dip, pulling back to the 50-day moving average. We're now rotating higher, clearing that previous high. I think gives a nice all clear sign. BMY is Bristol Myers. So Bristol Myers is arguably kind of right at that point, right? We're testing this key resistance, sort of in the 49 range, going all the way back to the end of April, mid-June, late July, late August, mid-August, are all sort of around 48 to 49. We're kind of right back up to that point. We're also right up to the 200-day moving average, right? So you had this consolidation here. We had this clear breakdown and a breakdown of the 200-day, which told you new distribution phase. Now it's really been consolidating for the last 6 months. Is this the exit from the consolidation phase? Confirmed break above the 200-day is what I would be looking for. But today's rally really putting that into gear. That's why Boston Scientific, I would argue, is back to being a decent chart, because we've now made a higher low around 98, and today pushing back above the 200-day moving average. We tried that back here in October, and if you bought that breakout about 2 days later, you probably stopped out because we're back above the 200-day. That's the risk you take with a position like this. Rallying above the 200-day, you're betting on a sustainability of that breakout and seeing additional buyers come in. So the way I tend to think of a chart like this is where you probably take you can take a partial position, right? Take an initial position, a more aggressive position. And if the follow through comes as you'd expect, then you get there. You add to the position and complete the position. So if you're concerned on a chart, not that this is the perfect chart or anything, but if you're looking at a chart and you're like, I don't know about going all in, remember, right? You can take a partial position, put a third of the position on. Think about your target allocation, 2%, take like a third of that. And then if it starts working, add a little bit more. And that's how you ladder into position. You don't put too much at risk up front, but you start to add into it as the chart would validate. As the chart tells you it deserves a place in your portfolio. So within healthcare, I'm seeing a lot of interesting, very actionable charts, kind of testing resistance, potentially breaking through resistance. A number of charts on there to watch. All right, let's finish off looking at more charts. Here's the daily chart of the S&P 500. As a reminder, by the way, I'm happy to hear your questions at any point on our YouTube channel. Just drop a comment below the video that you're watching. We'd love to hear from you and hope to answer one of your questions in our next mailbag episode. The way I'm thinking of what's happening this week, on Friday, we sold down to the lower trend channel line. This is a trend channel. Those gray thick lines are basically looking at the market from the end of June to where we're at now in mid-November. You can draw two almost perfectly parallel lines that basically capture the trend from the end of June to now mid-November. What that means is, generally speaking, I'm expecting the prices to bounce off the lower trend channel line. And if we get to the upper trend channel, I would expect prices to pull back. And that's kind of what's happened after we initially draw those lines. Look at how many times that happened after those first couple points are connected. So Friday, we actually traded below the trend channel, but closed back above it. We also traded below the 50-day moving average and closed back above it. That sort of pattern where we trade below support, but buyers come in by the close and push above there, that was a great sort of leading indicator that the beginning of this week was going to be pretty strong. Now, over the weekend, headlines about the government shutdown, finally getting some relief from that, and maybe getting back to some of the data that we've been not getting for a while, jobs data, inflation data, et cetera. I think that will all be quite helpful. I think that there's going to be could be a very big difference between this short-term rally on optimism that the shutdown is over versus the reality of what some of that data might tell us. And I think that's still very much an open question. I'm hearing a lot of optimism that the economy is strong and that things are great. And this whole thing with AI is totally reasonable and that the valuations are sound. I would say there is definitely another side to that argument. And if the economic data does not come in as good and it looks more recessionary, I think this could be a big wake-up call. After we've just it's going to be a fire hose of economic data potentially here over the next couple of weeks. Overall, hopefully that the shutdown is over very, very soon. It's been more disruptive than anything, I think, for most of us as we look around. All right, looking at the breadth conditions, breadth starting to improve a bit this week. One of the I think key aspects of this trend and how it's evolved from like May into like September and October has been the complete change in the breadth picture. Earlier on in the advance, back here in like May and June, you're seeing the market move higher. Early July, you're seeing breadth conditions improve as markets are moving higher and the McClellan oscillator is improving, telling you this is an acceleration in breadth data. But then all of a sudden, from then on, the McClellan oscillator spent way more time below zero than above zero. And that speaks to short-term breadth weakness, right? And a weakness there. Yesterday, this is through Monday's close, the McClellan oscillator just went back above zero after spending about 2 weeks below zero. Today, given the breadth data, I would assume that the McClellan oscillator bumps up a little bit further and remains above zero. If that would be sustained, that would no longer be one of the big red marks on this current market environment. We actually saw an improvement in stocks above their 50-day moving average just this week. We've gone from around 40% up to just over 50%. So it's a coin flip at this particular moment. If you pick a random S&P 500 stock, whether it's above or below its 50-day moving average, further improvement, getting back above 50% would be a great sign. The percent of stocks above their 200-day, getting back into like the 60, 70% range, that'd be a really good sign. I can't guarantee that's going to happen, but certainly if I'm bullish, that's something I would be cheering for right about now. It would feel a lot better if the breadth conditions really started to improve. We talked about semiconductors earlier. Chart of KLAC looks very similar to the chart of SMH, which is the VanEck semiconductor ETF. We can see the new highs early October into late October. We can see the clear bearish divergence, the price going up on weaker momentum readings. That's a problem. But the real problem, I would say, is the fact that we're testing the 21-day EMA. Last week, we traded below it, that nice hammer candle, which led into Monday's gap higher. Today, though, while the Dow is moving higher, the SMH is actually moving back to retest the 21-day EMA yet again. The RSI is currently holding at 50. Certainly would want to see that held. And note that semiconductors, along with technology, are underperforming so far in the month of November. We're only a week and a half into it, but certainly a potential change in this string of consistent outperformance that's been in place really since the end of August. Some semiconductor charts look a little more vulnerable than others. I would say Broadcom stands out to me, testing the 50-day moving average on Friday's session, kind of once again getting right back to that point. We've had a number of pullbacks to the 50-day for Broadcom. Every one of those, we've seen a nice bounce higher. At some point, the 50-day is not going to hold, and I'm going to be there watching that chart and letting you know about it. RSI is holding right at 50. We're kind of right at that point where this looks for like changes from an okay chart to maybe a struggling chart, particularly on the shorter term time frame. So which leading growth names look good? It's the AAA strategy, Alphabet, Apple, Amazon. We'll quickly go through these. What makes these the three best Magnificent Seven charts? They are in a strong uptrend of higher highs and higher lows. moving averages in the proper order, meaning price above the 21-day EMA, which is above the 50-day moving average, which is above the 200-day moving average. Relative strength strong for Alphabet, checks all the boxes. For Apple, checks all the boxes. Note that both of those pull back a little bit going into the month of November. Alphabet held that gap from the end of October. Apple holding above the 21-day EMA, which is pretty encouraging. With the gap higher we had on Amazon, Amazon's a little choppier than the other two, but still well above the July and September peaks. That resistance level sort of lining up with this gap. That's where we bottomed out last Friday with this little hammer candle here. Moving averages in proper order, momentum strong but not excessive, outperforming. It's the AAAs that are the class of the Magnificent Seven: Apple, Alphabet, and Amazon. Folks, that'll do it for today's show. Thank you so much for watching me here on Chart This with Dave Keller. Don't miss the latest episodes of our Market Misbehavior podcast. I mentioned today's interview with Andrew Thrasher. Hopefully we'll have ready for you very, very soon. Last week, 2 really good episodes. One's with trend follower Jerry Robinson, the other with author of The Income Factory, Steve Bavaria. 2 very different but very compelling discussions with some really thoughtful and knowledgeable market practitioners. In the meantime, have a fantastic evening. Wish you well. Hope everything is good your way. And remember, it's always a good time to own good charts. Have a good night, folks.